Hi everyone, welcome to ELI, the place where you get your daily dose of inspiration for entrepreneurship. And today we have with us Mr. Anil Pinapala, who is the founder of Vivifi Finance, which is a fintech platform that uses AI to expand credit access to non-prime customers. Hi Anil, welcome to ELI.
Thank you. I appreciate having the platform of ELI and the wide audience that you bring with it.
I would request you to introduce yourself to our audience, please.
Hey, as Priya just mentioned, I'm Anil Pinapala. I am a fintech entrepreneur. I have been in the financial technology space well before it was started to be referred to as fintech now for over 20 years.
Mhm.
That makes me a little bit older in this particular domain. But I spent a good portion of my life initially in the US, mainly working and building a business, which was my first venture, which was into financial technology for primarily deferred presentment or short-term personal loans in the US,
Mhm.
focused on the underserved and unserved communities within the US market. Initially, I was with technology and product with our first company. Once I exited that company, where we built the state-of-the-art loan management system about 18, 20 years ago, from which I existed 10 years. I then started a fintech venture in which we partnered with other lending entities in a co-lending model to build a book which was almost $1 billion, sorry, which in which we disbursed over $1.5 billion and collected over $2 billion in a 4-year period. And then as we were doing it, we built a large back office in Hyderabad in India. And as I was traveling back and forth, I realized there was a huge underserved and unserved market with unmet credit needs within the Indian landscape. And I was, and as I was originally born and brought up in Hyderabad, I thought we should do something to set up and address this unmet need within India, and that's how Vivify was born.
Gotcha. Uh, uh, I have heard people speaking that India is not well penetrated in terms of credit access, and there is a huge scope of credit because there's a lot of people who can use the credit, but they are not taking credit to maybe use it in a business or maybe a personal purpose. Having said that, tell us about what is the exact problem that you are solving through Vivify and how deep it goes. If you can just share some numbers to put things into perspective.
Yeah, you're very much right, Priya. India is a very underserved credit market, and consumer credit to GDP in India is only about less than 15%, whereas in developed markets it is close to anywhere between 75 to over 75% to 100% in truly developed markets.
Hmm.
So that just talks about how little credit we have, some of which has to do with our historical predisposition to not wanting credit and being a savings economy. And a lot of that has changed in the last 15, 20 years. But still, credit is a elite concept in India. When we are talking for a country about 1,300,000,000 people, we are talking with some country, we just have 55 million with a credit card.
Yeah.
Only about 150 to 200 million people have a credit score. Um, but a credit score doesn't mean you get credit, right? Like the reason we have only 55 million credit cards, even with 200 to 250 million people with a credit score, is that the banks and the traditional NBFCs have largely left out people with lower incomes, people with incomes which are not from formal sources of employment, people with salaries who are not from large companies, people who are self-employed. Large swaths of Indian population, even though they will be credit worthy,
Mm.
have just not been served by the Indian financial system, be it their banks or the traditional NBFCs. And that's where we saw an opportunity with Vivify. And our specific segment we look for and we are looking to solve for our customers with incomes below 30,000 rupees.
Mm-hmm.
Um, at the same time, we are just not saying income is the criteria. It could be any customer who is unable to get credit. And as I said, a driver who has regular employment, but it's not formal employment, will not get credit. Whereas with Vivify and FlexPay, they have an opportunity to get credit because we treat any recurring income as salary. It doesn't have to be from a grade A employer, or you don't have to be from a tier one city. And when we are talking about the opportunity, as I said, only 55 million people have a credit card. Less than 100 million people have a personal loan, which is unsecured.
Mm-hmm.
We are talking about the India, which is the next 300 to 400 million people who just don't have access to credit. And that's where Vivify is stepping in and offering credit. And we do this based on the strength of underwriting. As I said, we come with a very in-depth experience of lending in mature markets over 15, 20 years. And within India, we have been operational now for over 3 to 4 years, lived through a tough COVID period, and now have very mature underwriting algorithms, and have built a lot of experience and expertise even within the Indian market to layer on the foundation and the strength we have in other markets. And we are starting to build a big and a nice book of business that is not just bringing credit to 400 million new Indians who are outside the credit portfolio, but also to do it with the principles of how credit businesses should be built. Credit businesses are not built by burning money, they are
Mm-hmm.
built on strong fundamentals. And strong fundamental means low NPAs, focus on profitability, um, very meaningful cost of customer acquisition, which is focused more on lifetime value of the consumer. So that's how we are building Vivify.
Got you. So when you say non-prime customers, so these are, like you mentioned, these are people with a low income bracket, and there is a reason why the traditional banks do not go after these type of customers. So tell us, what is the fundamental difference from a NBFC or from a financier's point of view on lending to prime customers versus lending to subprime customers in Indian context?
So in Indian concept, a prime customer is typically someone who's from a top 10 city, a metro, making 50,000 to 1 lakh rupees a month or more, has a credit score over 700. And the moment they're in a job or any place, everybody's clamoring to open a checking account, give them a credit card, and give a personal loan and everything else. So that top of the credit spectrum has a lot of credit access in India, and a lot of fintechs. Also, what they have done is they have solved for speed there. People, younger people, don't want to walk into a bank branch to apply for anything, including a loan, and a lot of fintechs have focused there. India also has a very unique phenomena, right? Like if you look at the bottom of the pyramid, which is low income, self-employed folks, the microfinance revolution in India brought a lot of credit access to them. But if you look at tier one, the urban low income segments, and tier two and tier three segments, which are not in this group lending model, there is a complete large gap. And that's where the traditional way of underwriting has failed these consumers because it is all based on either asset based lending, which is secured. And a lot of these customers do not have assets. So loans against portfolio, other things don't work for them. And these customers just don't make the cutoff criteria for many banks and traditional NBC. When I say cutoff criteria, the banks say these are the 2,000 employers I'll deal with. These my income cutoff is 40,000 rupees.
Mm-hmm.
I will not deal with any customer with less than 3 years of employment maturity. I will not look at any customer below 750 credit score. When you just fail one of these criteria, you just don't get a loan in India. And that's where we said all of these customers can be underwritten. and they can be underwritten on the basis of their cash flows that they are able to get. And just because they are not from a particular city or not from a particular company, or have a lower income, should not stop them from having access to meaningful credit. And that's where we have built our entire algorithms that will underwrite on the potential of that consumer to repay, which extends beyond the credit score, which extends beyond. So that's why we do bank transactional data analysis to build our credit models. We'll look at customers' payment history with other service providers as a tool. So all of these data points have given us the ability to extend credit to these consumers. And today, when I look at our consumer portfolio,
Mhm.
while we have a large non-prime base, we also are having some prime customers in our portfolio. It mainly comes because we also not just innovate on the consumers we want to serve, but we innovate on the product. Our product is all about flexibility, the flexibility to withdraw money anytime you want, and the flexibility to repay money at any time. So our product does not have any prepayment penalties. We don't restrict the consumer to say, okay, I grant you a 2 lakh rupee loan, but if the consumer's need is only 50,000 rupees, it is up to the consumer. They decide, the borrower decides, I need 50,000 today. Okay, I'll take 50,000 today. And 2 months later, I'm about to hit a Diwali bonus and I can repay the loan. We don't put them in a fixed EMI. I mean, there is a EMI, there is a payment that we suggest, but the customer can say, okay, I'll make 2,000 rupees this next month and I'm about to get a Diwali bonus, so I'll repay the loan. So we give that flexibility. When you're dealing with low income consumers, their incomes stay flat, like they'll get a 20,000 rupee income every month, but their expenses go up and down. There is a school fees, there is a birthday, there is something else, emergency in family. All of those things will, if you put them in a EMI product that forces them to stick to a payment schedule, it becomes difficult for them um, to follow that schedule, because suddenly they'll have an expense or something that if they are unable to meet the payment, then they are a bad customer, because that delinquency gets reported to credit bureau and then there is a larger impact. So we built a structure and an innovativeness around the product itself that not just non-prime consumers but even prime consumers love. So that's the way we have solve with innovation on underwriting and innovation in product definition to address this market.
Got you. Speaking of bad customers, I have personally met people who are
Once more, I never said bad customers, customers who have deficit to credit access. But yeah, go ahead.
yeah. So I have personally met people who are willful defaulters of credit, and the reason is especially in rural India, people are not well educated, well financially educated, and they do not understand the consequences of not paying back the EMIs. So how do you, from a product point of view and from a business point of view, deal with the repayment part of the credit business, and what happens when the default customer doesn't pay back the EMIs?
I've always said about credit businesses, it's very easy to give money, right? Like the most important and the difficult part is getting it back.
Yeah.
And that's where there are multiple ways to deal with it. Obviously, underwriting is the first layer. And when we are talking about underwriting, there are four layers you are always looking to do. Eliminate fraud, make sure that you have processes and technology that eliminates fraud. Second, establish the intent to repay. You have talked about willful defaulters. Um, at certain level, underwriting and credit models can help you weed out customers who have intent issues. The next layer is ability to repay, and fourth layer is ability to collect. So when we are talking about our customer base, we focus mainly on education, because we are doing loans from as low as 500 rupees to as much as 2 lakh rupees. And when we are talking about a small loan to the consumer, we talk to them about how it is important to repay because they are not in the formal credit system most of the time. So this is we are the first institution or one of the first institutions that's extending credit to them. So we educate them what this is about to do. This is about to bring them into the formal credit world because every payment they make gets reported to all the four bureaus. They're building their credit score. The cost of not making a payment when you are getting a 10,000 or a 20,000 rupee loan and you have a payment obligation of 1,000 rupees or so, not making that payment has multiple levels of impact. One, it affects your credit score. Two, you have a 1,500 rupee, 2,000 rupee payment, and we ACH the customer and the check bounces, like the nudge mandate bounces. The banks charge the customer 500 rupees to 1,000 rupees. So the cost of not paying a 1,500 rupee payment could be 1,000 rupees. So this is the education is much more important because customers sometimes make poor decisions
Yeah.
if they lack information, and that's what we focus on in trying to give them information. That's why our efforts to communicate with the consumer don't stop at giving a loan, but every payment due date 10 days prior we send messages, we do calls, we ask for customer preferences, and the system decides which customer responds better to calls, which customer responds better to messages,
Yeah.
and then keeps them engaged and educated, um, emphasizing the need to make payments and maintain good credit score.
Gotcha. Curious to know about one aspect. You said you send messages and make calls to people who do not pay on time, and there is a cost involved in that activity. So curious to know what happens when the cost of recovery is more than the loan that you have given to the customer. For example, 500 rupee loan that you just mentioned. So what happens if a person takes 500 rupee loan but doesn't pay back? What is the process involved in that?
See, yeah, we focus on customer communication not just when the customers fail to pay us. As I said, we start the communication even before their due date because it is important when it's a customer who is underserved and is not in the formal credit system to emphasize on the importance to repay. And when we are talking about a customer with a 500 rupee loan or a 2,000 rupee loan or a 5,000 rupee loan, our decisions on calls and messages are not based on what the customer is today. Our decisions are based on that we are building a long term lifetime engagement with this customer. And when we give a customer a 500 rupee loan or a 5,000 rupee loan, we are not thinking that when this loan gets repaid that this customer is not going to be our customer. So our decisions are not based on the short term profitability need. Obviously we are different, we are trying to make sure we are profitable at an overall portfolio level, but some individual decisions are not made on recovery amounts but based on the long term potentials the customers offer us. And it's about building trust and faith in us. And because we are a young NBFC, which is a fintech, which is trying to offer solutions to a largely underserved consumer, we cannot just take the traditional approach and we can't say, hey, this is just a 500 rupee loan. I don't want to deal with the cost of recovery. I
Mhm.
need to make sure that this customer repays, and maybe 6 months down the line, maybe 12 months down the line, I can do a 25,000 rupee loan with him. Maybe I'll do a 2 lakh rupee loan with him. And that's how you, when you make those decisions based on future value or long term lifetime value of the consumer, you don't make those short term decisions based on today's contract value.
Anil, tell us a bit about your personal journey of entrepreneurship. How did it all start? What motivated you in the first place to, start an entrepreneurial journey?
Yeah, I mean, I had the entrepreneurial bug right out of my college when I was doing my master's at IIFT in New Delhi. Um, I was that was kind of right about the first dot-com boom when I was graduating, and I had really wanted to be an entrepreneur, and I partnered with a couple of entrepreneurs who techno technocrats who were setting up a new venture at that time.
Mm-hmm.
And I was a part of the founding team that built one of the first B2B platforms in the world, along with Ariba and Commerce One. So I mean, I never truly worked. I was 6 months in a job, but never really enjoyed it. So when this opportunity showed up, against the advice of my parents and everybody, because I came from a very humble background, and I went through formal education, taking loans and everything else.
Mm-hmm.
So when the opportunity to came to start earning back and paying back all those dues, the fact that the entrepreneurial bug was about to take me over wasn't seen very kindly by my family. Uh, but um, um, but I mean, I took a chance at that time. I was a part of a good founding team. Um, and as soon I realized that after I did that, the dot-com bust happened. But we changed course. We built probably one of the best SaaS product coming out of India with a product called Q Fund, which I architected. Then I was a part of the entire customer acquisition process for that product. And then, as a CEO of the company, built that business to a large business for a 10-year period to be the leader in that space in short-term personal loan finance in the US was a very satisfying thing. Obviously, it was very rewarding, that entire journey. I exited that business in 2013, and as I said earlier, I launched another fintech company in US in 2014 because as rewarding as the loan management system, sales, and technology portion of the business was, I
Mm-hmm.
saw a lot of people use the software we wrote to build large businesses and successful businesses. So I thought I knew enough about lending to venture into it, and I had a able partner in my wife Mridula, who was a part of my new venture, and one of my colleagues from the previous business, Srinath, who when we started Tech Friday, were nice enough to join the team and start on a new journey of building a mobile first, machine learning based, underwriting driven lending company in the US. This was back in 2013, which was at that time was very cutting edge, not anymore. And there we built that business. Once more, we wanted to do into leasing business, but we kind of learned along the way that it was difficult to scale that. So we went into proper digital lending. And then as that business grew, as I said, over a 4-year period, we loaned out over $1.5 billion, collected nearly $2 billion. And then went from and most of that was built was not on our own licensing. We partnered with lending companies, and as I saw the opportunity in India, one of the companies wanted to acquire us, and obviously, as an entrepreneur, exit is one of the things that gives you the most satisfaction. So we had an opportunity to exit, so we exited that business and started the Indian lending business. But in all of this, what I have seen is what matters is the people around you.
Mm-hmm.
You will have a lot of lumps along the way, lot of course and directional changes you need to make. Luckily, only in the Indian business, we kind of made a business plan and we are sticking to it. There also 2 years of COVID was challenging, but as long as you people who share your vision are with you, and then especially in your co-founders, and beyond that, as you are building your team, if you are able to find young talent, hungry talent who are able to share your vision, that's the key to being a successful entrepreneur. Because I mean, I was and my team was lucky in the sense that we had two successful exits, which were the two ventures with some course corrections. But not every venture has to be a successful exit. But as long as you have the right people around you, irrespective of the outcome, the journey will be, and the learnings will make sure that success will be one day yours. Uh, whether it comes sooner or later is just a matter of execution.
Yep. My final question for you. Tell us, what is the meaning of entrepreneurship? How would you define the term entrepreneur? Who is an entrepreneur from a skill set point of view or from a personality point of view? What is the definition of entrepreneur?
Uh, I should have gotten a memo that you'll ask me this question, or I should have guessed it. It would have been easier for me to think through this. But I think an entrepreneur is a risk taker first. Um, an entrepreneur is a value or a wealth creator second. And an entrepreneur is a leader who is compassionate and can lead people to a vision that they see. So I think all the three things are important, right? If you cannot be a risk taker, you should not be an entrepreneur, because that's the definition of being an entrepreneur, that you have to chart a course that is less taken, especially in this world. If you're trying to set up a new venture, it can't be a me too, it has to have differentiation. So every level, at every stage, there is a various levels of risk you need to take, and you should have the ability to stomach those and kind of work through the challenges. The
Hmm.
second thing, as I said, an entrepreneur is a value creator or a wealth creator. Value creation is the first step. Wealth creation is the consequence of value creation. And unless you are able to execute your vision and create value and wealth, then you probably are not going to be successful as an entrepreneur. And the third thing, as I said, an entrepreneur is a leader. When I say leader, it's not in the traditional sense that you have to make a rara speech. You could lead by, I mean, there are several various ways you can lead a team, but the team needs to, one, believe in your vision, share your vision, and then help you in executing that vision and bringing your dream to a reality. And that only happens when they're invested in your idea, and having the right team around, and having the ability to motivate and lead them to success is one of the more defining features of being an author.
Well, on this note, we will close the session. Thanks, Anil, for joining us, and it was a absolute pleasure to have you on our platform.
Thank you, Priya. I appreciate that opportunity to be on this platform, and it was an enjoyable experience for me too.
Thank you, Anil.